As an investor or a trader, your goal is always the same: buy and sell more profitably. This means you need to create a consistently profitable strategy, one that identifies the true levels of support and resistance. Part of this process is to avoid emotional decision making. The markets are highly emotional, but what you will find is that people buy and sell at the wrong times, and you must avoid doing so. In this video, I'll explain what actually moves the market and also to stack probabilities so that you can time the markets more effectively. I'll also help you to realize that there's always a deeper reason behind price action. I'll also help you to look below the surface level price action to understand the hidden architecture of price movement. Let's run the numbers. To understand what actually moves the markets, I would suggest that you download the free watch list from CTKSMethod.org. These particular rows cover off what's called the cheat sheet. In row 1, we measure risk, and what we saw was the VIX decaying. That's what led to the upsurge in market price action throughout the stock market. We had slight confirmation in row 2, which measures risk off. Row 3 did really well. These were the major market indices. And row 3 references also did well, with exception of the DAX. Row 4 gives us an understanding of the stock market, and MicroStrategy did particularly well. Right at the current time, the crypto market is retracing. We have a flow into stable coins, which is this market cap USTD dominance, and we can see that total crypto market cap and its associates are withdrawing in terms of price at the current time. Row 6 is the crypto market, row 7 is also the crypto market. We can see that we've got negative price momentum, and I'll explain why that's the case just coming up. Inside the memes, which are a good indicator of risk on or risk off sentiment throughout the mainstream media, and also the gateway to new investors and traders inside the crypto market, it's also negative. One of the things that we need to look at are the row 1 references. They're currently negative. So there's a lot of stuff happening inside the market. But the first thing is that you need to understand intercorrelation and interconnection. And one of the things recently that caused the meltdown in markets, and a lot of people are talking about this, is the spike in the VIX. The VIX has been going up and up and up, primarily due to tariffs and the threat of global instability. But we can actually see that VIX is starting to retrace. It will take some time to get used to reading the cheat sheet, but when you do, it's an absolute game changer. All you need to do is to go to CTKSMethod.org. Just on the home page, just scroll down until you see your cheat sheet to mastering price action, and you can download it absolutely free. Markets are also moved by rules. Rule 225 is a particularly important one. Bitcoin cannot escape the stock market's gravity. Now, if you are looking at the cheat sheet, you saw that the main markets rallied, but crypto has gone red. Why? This primarily has to do with the NASDAQ futures, the S&P 500 futures, the Dow futures, and the Russell futures. These futures are currently just consolidating at the current time. They have a degree of negative price momentum. The best markets to watch for a signal inside the crypto market are definitely the Russell 2000 futures. If I was to zoom out a little bit more, you can see this up and down blue line, which is actually Bitcoin's price, is very influenced by what the major markets do. If the futures of the main markets are coming down, expect Bitcoin to come down, and they are currently coming down. Bitcoin is highly risk sensitive. This is another rule that you need to understand. Now, how do we stack probabilities to time the market more effectively? If you time the market effectively, you can make money in any market condition, and that should be your focus. First of all, we need to understand what the major market indices are doing from a structural perspective. A retail perspective, it's very simple. Retail just looks at moving averages, Bollinger Bands, and other things, Fibonacci retracements. You must be aware of that, but you also must be aware of structure. There are always deeper reasons behind price action. When we look into the S&P 500, what we're looking at here, these shaded areas are called SZs or Stanfield zones. They're the combination of specified levels from level 1 and level 2 standards certification. They are not randomly drawn lines. They are known from the start of the month and they do not change. What we can see here is the S&P 500 was coming down, found a degree of support around that 5670, bounced into overhead structural resistance but couldn't hold it, had a structural failure and decayed back to this level of support, took out the lower levels of support as well, but these levels are very, very strong. This is exactly and precisely why the S&P 500 bounced. If you don't know where this structure is or you don't know how to read this structure correctly, you will mistime the market and you will be forced into emotional decision making. Emotional decision making just simply means you will lose money. Unfortunately, this is just the rite of passage inside the markets. Now we can see that we've found a degree of structural support and we're coming back to see if we can get above that 5670. Therefore, the thing to understand, there are always key levels inside the market. You may not be able to see them, but they are always there. Now, what it means, if we get above 5680 inside the S&P 500, the next level of overhead structural resistance is around this 5780 mark. There are basically two ways that you can look at price action. You can look at it from a retail perspective, which is all emotion. For example, whenever there's a green candle, it's going to infinity and beyond. And whenever there's a red candle, it's going to zero. This is unfortunately emotional decision making and something that you must stay away from if you want to be consistently profitable. To move away from emotional decision making, which is an absolute requirement, you must understand the hidden architecture of price movement, and that is revealed by looking at CTKS structure. Okay, what does that actually look like and what is it? CTKS structure is the most statistically significant structural support and resistance lines in existence, without question. Now, what are we seeing here? Remember how the US market futures were rallying and then they decreased. This was what caused Bitcoin to come down just recently. But everything is structurally bound. What we saw inside the crypto market is Bitcoin sought to get above this 24,557 area of structural resistance. It tried to get through it on Saturday, tried to get through it on Sunday, tapped it and has retraced accordingly. This is a very important level to keep your eye on in the future. Also, we saw that on Saturday's price action, we basically just flatlined, which does tend to be the case across the weekend because it's fairly low liquidity. If we get any movements, they tend to occur late on Sunday night, Australian time. And we saw that we got this sell down. Now, where did we get the sell down? Where were the safety nets? The safety nets inside Bitcoin's price action were 83,483, 83,148, and 83,029. We saw that we had that structural failure at 84,204. The safety nets kicked in, rebounded price just like a trampoline. And then the futures of the major market indices said, nah, I'm retracing. Why were they retracing? The futures were coming down because people are very uncertain of what's happening inside the stock market and also inside the crypto markets. They were just pairing off risk, but we've seen these safety nets come back and kick into action as they always do. The hidden architecture of price action and price movement is always revealed, and this takes two levels of standard certification to draw up on your charts. These are not random lines. Now the thing to note, we do have on a daily basis, we do have support inside the crypto market. So even though we saw a bit of a flush out here, we're still under a degree of upward price momentum. Now this is really important because when you get a cut under, you need to pay a lot of attention to negative price action. I would suggest looking on the daily basis for these cuts. If you find that you get a cut over, which we've just experienced, as well as the support in price action, it stacks the probabilities to upward price momentum. So long as the major market futures remain positive and keep on going up, we expect Bitcoin to go up as well. But go up to where? That is the critical question. The answer is always the same. Up to a structural resistance level. But where are the major ones? What are people going to be looking at? In order to understand that, you must think from a retail perspective. Retail will be looking around this 85,644 level. This is the 200-day exponential moving average. Now the 200-day EMA will give traders and investors who are retail, not institutional, but retail. Retail just means emotional. And people simply get emotional when they are unsure what is going on. Retail craves certainty. They must know where price is going. Professionals are completely different. Professionals will look at price action and just say it's going from structural level to structural level to structural level in a wave. That's all price does. You just need to understand where the structure is. Retail will be saying around this particular area, there will be a lot of structure supposedly inside the market. Now I'll just put this on here and I'm going to zoom into that price. You can see I've zoomed in to this 200 period moving average. Now where is the structure? Is all the structure below that? Is it above it? Is it on it? When you think from a retail perspective, the line is the structure, but is that actually the case? No, it's not the case whatsoever. The structure is actually above it. So what you can see is it's just there and just slightly lower. So the structure, in fact, is in these two areas, one up here and one just here. Now, what does this mean? It means something really important. People will think that as soon as the 200 period moving average is overcome, around that 85,600 level, as soon as that is overcome, it's all clear sailing. This is clearly not the point. Institutions know this, retail knows little, unfortunately. Therefore, there's always a deeper reason behind price action. If we find ourselves coming up to these particular levels, the retail level will be celebrated above 85,600, but that's where we're actually getting into trouble and not where it's cause for celebration. This is a way of stacking probabilities, but stacking probabilities typically occurs across and through charts. What is important here is to understand the hidden architecture of price movement. Prices are simply rebounding from structural levels in waves. That is it. It's no more complex than that. Another thing that retail will do, it will only look at its money chart. Now, this is a very, very big mistake. For example, if you're inside the crypto market looking at total crypto market cap, and perhaps you're trading XRP, ADA, Solana, Bitcoin. It doesn't really matter what you're trading. But if you're not looking structurally at Bitcoin and structurally at total, you're making a huge mistake. You're not thinking as an institution of one. Now, when we look at total crypto market cap, we can see a very similar price action behavior or fingerprint that played out on Bitcoin. Now we know why this is occurring because the major market index futures are retracing. But where are they retracing from? You can see that we got up to the $2.71 trillion level on the total crypto market cap capitalization, and we were rejected from that level. Remember, Bitcoin was rejected from a level as well. we just decayed through and got caught by the first safety nets. Those safety nets failed and we were caught by safety nets below. Price is always moving structurally between these safety nets. If it can't get above, it's going to the safety nets below. If it can't get above, it's going below until it gets more and more safety nets. Now, these safety nets are gravitational, which means that they can pling price up as well as push price down. You've got to get used to reading how price is interacting with structure. And right here we saw it weakening. This meant that we were favoring lower structural levels, and these levels around the $2.69 trillion area were quite strong, but we had a sell down in the major market indexes, which caused this price behavior. Always think the VIX is playing through your charts at all times. Even if you can't see it, the institutions can. A very helpful tip for you to understand is that Bitcoin in times of market turbulence attracts capital inflow. Now, what does this mean, particularly to the alts? If we look at Solana from a structural perspective, and we'll just throw the indicator on. If we look at it structurally, we can see across the weekend, this 138.17 was just unattainable. The sellers were just too strong here. See this negative price action. We saw that in total crypto market cap as well. When total was failing structurally, the entire market was also failing. You only need to keep your eyes. And one of the things that you can look at when you understand structure, you know that these structural levels extend to the right. Here is price action, here is an extension to the right. Now, what does this mean? It means simply you know where price is going to interact with smart money. You can see already at that 126.62, the buyers have been entering at this point and supporting Solana's price. But everything comes back to Bitcoin and total crypto market cap and its intercorrelation with the major market futures at the current time. If we get positive momentum inside the futures, it means the VIX is retracing and junk bonds and risk on are increasing. If that is the case, we're going to get forward price momentum inside the crypto market. A lot of people will just look at their money chart and make decisions from this, never understanding intercorrelation and interconnection are the only ways to stack probabilities so you can time the market more effectively. Another thing that we saw across the weekend, BNB went absolutely ballistic, but it came into two levels of very severe overhead structural resistance, one at that 618.9 level and 613.8. Because total crypto market cap and Bitcoin were both retracing, Bitcoin had no choice but to retrace as well. This is why if you get a push up to an overhead structural level, don't worry the fact that this is BNB. That's irrelevant. You want to look at how to interpret these lines of structure. Thicker always means stronger. If you're getting more clustered lines, that also means stronger as well. Weakness is enforced by cut unders. As soon as you get a cut under, it means weakness is afoot. If a structural level cannot hold, it favors negative structural attraction to levels below. Another way to stack probabilities is to simply look through the structural levels on the cheat sheet. For example, when we look at Litecoin around that $93 mark, there was so much overhead structural resistance. It got pushed down when total crypto market cap was failing and Bitcoin was failing. But the structure inside Litecoin's price chart held. There are also lower structural levels here. If you're inside the service and you find that you're missing lower levels, just simply right click, particularly on this text, right click and press update source code. And TradingView has had a lot of problems. The indicator is coming through as March, but on the invite only scripts it registers as February. I've been talking with TradingView about this. They're seeking to perhaps roll back their changes. What's important here is to understand that how you read structure on one chart is how you read structure across any chart. It's an incredibly simple methodology. And you already know that Litecoin will have issues around that 93 area. From a lower level, we're going to get into structural support around that 86, 80 area. Hopefully what you've seen is in order to stack probabilities, you must look at structure between different charts of the cheat sheet. It will just be an absolute game changer. And there's always a deeper reason behind price action. You can also understand the hidden architecture of price movement by looking at these CTKS levels or Stanfield levels. They are incredibly valuable and incredibly powerful. In fact, they're the world's only leading indicator of price. You already know where the structure is in terms of resistance and in terms of support in advance. It is incredible, absolutely amazing stuff. Therefore, if you're buying or selling based on a color, if it's green or if it's red, this is absolutely entirely the wrong way to do it. Unfortunately, that's what retail does. Retail will buy green and retail will sell red. This is absolutely the wrong thing to do. Why is that the case? Because price is always moving between structural support and structural resistance levels in a wave-based function. When it does so, what it's actually doing, if it's going green, it's in the process of moving into structural overhead resistance. If it's going red, it's in the process of moving down to structural support. So this is akin to buying the top, selling the bottom, buying the bottom, or buying the bottom if you're buying on red with structural awareness. And the whole concept of bottoms and tops is absolutely ridiculous. If people say, oh, I need to buy the bottom and sell the top, you know immediately that they're retail. Why would I say this? Because price is always moving in a wave. What bottom? What top? What are they talking about? It's not important to buy tops or bottoms. What's important is to understand structure, intercorrelation, interconnection, and time the market more effectively through knowledge and rules. Of course, there's a lot of other things that you'll need to look at. You'll need to understand the macro environment. It's kind of like drinking from a fire hose at the start, but I'm here to help you. Please let me know specific questions that you would like answers to, and I will definitely help you out in future videos. Also remember that the FOMC meeting is coming up on the 19th of March and there's absolutely no probability, well 1% probability of an easing. And a lot of people have no idea how to read the hidden structure of the market, even when it's published for public availability. Don't subscribe to stories, subscribe to structure. It will make you a fortune. And because you've stayed all the way to this point in the video, I'd just like to congratulate you. You're investing your time, effort, and energy into understanding the financial markets better. When you do so, this is an absolute game changer. Nothing we do here is retail. We are all institutional. And when you look at open interest can give you a very good signal. If open interest is supported and coming up and not rolling over, you would anticipate further price momentum to the upside. As soon as it starts to roll over, think that rolling over can decrease price right across the market. And that's exactly what it does. So keep your eyes on open interest. It's a really good statistic to look at. And as soon as we start to see behavior that starts to cut over here like this, we're in for a really good ride to the upside. And I'll leave this URL to this chart inside the description of this video to help you out. You'll just need to scroll down a little bit because I want to give you an advantage because you've earned it. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.